Okay, well, good afternoon or good morning, depending on where you're joining us from today. My name is Tony Cool. I'm a partner in Thompson Hine's corporate practice group. I would like to welcome you to today's webinar. This is the fourth in a series of webinars targeted at issues that businesses face operating in a COVID-19 world. Our next scheduled webinar is May 26th, and it is titled Paycheck Protection Program, the PPP loans, making sure you don't have to beg for forgiveness. We are planning additional webinars as topics arise. To sign up for those webinars or any others, please visit thompsonhine.com and our COVID-19 Task Force webpage. Before we begin, a few housekeeping items. Today's program is being recorded, and we will send a link to all attendees within 48 hours of today's presentation. If you have any questions during the webinar, feel free to use the question box located in the control panel on the right side of your screen to submit questions. We will try to answer as many of the questions as we can at the end of the webinar. We will be offering CLE credit for today's webinar. Please be sure to fill out and return the webinar affirmation form that can be found in the handout section of the control panel located on the right side of your screen. The form provides instructions as to where to send the completed form. You will need a tracking code, which I will announce at the end of the program. Also in the handout panel, you can download a copy of the PowerPoint slides for today's presentation and bios of today's speakers. Again, thank you for your interest, and if you have questions as we go along, please use the question box. I'm delighted to introduce my colleagues that will be presenting today. We're thrilled to have April Miller-Boyce, Executive Vice President, General Counsel of Eaton Corporation, and Benjamin Marks, Director of Mergers and Acquisitions at BMO Capital Markets, join us. In addition, I'm pleased to introduce my Thompson Hine colleagues, Will Henry, who is a partner in our corporate practice, and Emily Farinacci, who is a Senior Associate in our corporate practice. I'll now turn the presentation over to Ben to start us off. Ben will be providing BMO's current M&A market perspective and data regarding market activity and trends. Ben, the floor is yours.
Great. Well, thank you very much, Tony. And I am on page 4 of the presentation. And this is a chart depicting the S&P stock chart trend over the last 10 years. What I will say just as an opening comment is that it is really absolutely incredible, the speed of the pullback in the public equity markets. At the trough, we were down nearly 40% from our February peaks, effectively erasing all of the Trump era gains. What's equally or possibly more impressive, in all honesty, was the speed of the resolve on both sides of the aisle to put together an unprecedented and very creative stimulus/relief package. To put things in perspective for those on the phone, in the financial crisis, it took almost a year from the beginning of the downturn for the most aggressive measures to be taken, such as the quantitative easing and 0% rates. So it was very impressive that it took less than 6 weeks to put these into place. What's also become very clear is that it will likely require more effort on the part of the federal government. Most of you probably saw last week the Democrats passed a $3 trillion supplemental stimulus plan in the House that happened last Friday. Today, both Chairman Powell and Secretary Mnuchin testified in front of the Senate, mostly reassuring that all that needs to be done will be done to support the economy. It also appears that the White House will be supportive of some additional stimulus, but likely to a lesser extent. Definitely a lot more to stay tuned for. If you flip to the next slide, Tony. With back one, yep. With respect to just where are we at in the public market sense, at this point, the S&P 500 is only down about 10% since the beginning of the year. And we are seeing much less volatility in the markets over the last 2 or 3 weeks. Although, there was an uptick this week on the heels of, vaccine hopes, and there was some downtick last week on, employment figures and new unemployment claims. That said, not seeing the same volatility that we saw at the end of March. In addition, the pain from this crisis is not being felt equally across sectors. Some businesses are facing existential crisis, while others are relatively unscathed. Oil, for example, has been more severely affected, down almost 40%, followed by financials and industrials. Conversely, businesses in the technology, healthcare, and telecom space are trading relatively in line with where they were at the beginning of the year. Clearly, the market is trying to triangulate around some sort of recovery. If you look at share prices today, based on 2020 PE ratios, things look relatively overvalued. But based on 2021 PE, it looks attractively priced. The bottom line is that the risk reward has never been more uncertain in the public markets. What's going on, if you flip to this slide, in terms of M&A markets, we have seen substantial impact in the M&A environment. Just a few things to highlight. Mid-April, the week of April 20th specifically, had the lowest weekly quantity of deals in over 10 years and was 65% lower than the 10-year weekly average. And this is an even more impressive statistic. The week of April 13th was the first week since 2004, so over 15 years without $1 billion plus transaction. While volumes have come back in the last 2 or 3 weeks, weekly announced deal counts are still 60+% lower than they were in January or February. Let's talk about the macro environment. In terms of history, many of you probably saw US GDP contracted 5% in the first quarter of 2020. Very interestingly, if you were to peel back and look at that contraction on an industry basis, almost 50% of the contraction was attributable to the healthcare sector, pull back in non-essential care and other sorts of inputs to that end market. In terms of the go forward, economists from major US investment banks are predicting anywhere from a 25% to a 50% contraction in the second quarter, followed by some kind of recovery, whether that's a U, a V, or the Nike swoosh. More than anything, what this highlights is that no one really knows where we're going. In our business, we are counseling active and prospective clients to focus on a range of possibilities, the best, the base, and the downside cases, and really telling our clients they need to be prepared for any possible situation. If you flip to the next slide, with respect to the major actors on the M&A stage being corporates and private equity, I'll tell you a little bit about what we're seeing. In terms of corporate clients, if you were to look at today versus 10 years ago in the financial crisis, corporate debt levels on average are 30 to 40% higher today than they were in 2008 and 2009. So what is the impact of this? Liquidity is a buzzword that's been on the top of our mind and all other major banks' minds. Liquidity is at a huge premium for most of our corporate clients. This is resulting on strain that will prohibit M&A for many acquirers, especially large transactions, and especially in very severely affected industries. If you flip to the next slide, with respect to private equity, the theme in private equity is that dry powder, or the funds that they've raised or committed, has never been it remains at an all-time high. And we expect that private equity will be relatively more involved than corporates in M&A transactions over the next 12 to 24 months. From a buy-side perspective, we believe that there will be significant premiums ascribed to recession-resistant and pandemic-resistant or essential businesses. And the opposite will be true for businesses with the opposite characteristics. In the immediate term, we really do believe that they will be more focused on smaller transactions versus significant platform investments. From a selling perspective, we do think that private equity will be the last to return to market, given that their investments are really marked to a specific value, and they want to make sure that they're going to get full credit for any coronavirus implications. If you flip to the next slide, Tony. So what are the bottom line? So what are the two questions we're getting more than anything from our clients? How will the M&A markets reopen, and one, what will this new normal look like? And then how will the M&A process and deal making as a whole change? With respect to the M&A markets reopening, we believe that the M&A markets are likely to come back in 4 waves over the next 12 to 18 months. The first wave of transactions are likely to be distressed or recap situations. We are already seeing this trend in real time. This is capital that's needed to fill financing gaps that are left by banks who aren't willing to lend to specific companies or industries, or that the federal government isn't under the PPP loans. This will be more industry specific than anything. The second wave we anticipate is corporate carve-outs. Many of our large corporate clients, both public and private, are undergoing very detailed portfolio reviews and best owner analysis that will likely result in selling of non-core assets to shore up their balance sheets. The third trend, or the third wave, is likely to be privately held clients who will likely evaluate a sale to diversify their personal wealth and honestly to alleviate headaches of managing a business in crisis. The other motivator for closely held clients that we're beginning to see is tax concern. Belief that with all this government spending and the possibility of a Democratic leader coming into the White House, that capital gains rates that are at or near all-time lows are inevitably going to increase. The last wave, as I mentioned, is likely to be private equity, who will likely return to the market at some point next year from a sell perspective. How is our job changing from an M&A advisor perspective? A few trends that we're seeing. With respect to the pre-marketing and prep phase, it is taking longer than we had anticipated. And this is in part because we are very focused on having preliminary conversations with interested parties, meaning that we are strongly suggesting that our clients allow us to make pre-calls to the top 5 or 10 strategics and their corporate development teams to really ensure that if we do launch a process at any point this year, that the right folks are going to show up. Obviously, that universe of participants is going to be very different today than it is 6 months from now or even a year from now for many deals. The second thing we're doing is pushing very tight timelines, meaning we want to be in and out of the market very quick. We want to get clients to LOI, and we want to get to closing very quickly. Another topic that's top of mind along those lines is financing. Financing certainty will be critical. We will be incredibly focused on how buyers will actually complete deals. For corporates, we want to make sure that they've got the existing facilities and availability in place. For private equity, do they have a committed fund for the equity? Do they plan to max out leverage? And the bottom line is that we're likely to push for deals where it's possible to do a simultaneous sign and close, or push buyers, especially private equity, to accept lower leverage assumptions and then adjust the capital structure after the deal is done and once the credit markets have normalized. The last thing that we expect with respect to consideration is that it will likely remain cash or all cash, with a few exceptions. We may see stock utilized as currency in certain situations, especially with small and mid-cap public companies, where the seller may see value in accepting stock that's relatively undervalued. And the second piece is we do expect to see short-term earnouts, especially earnouts tied to 2020 performance, which is, as many of you know, very, very short in terms of timeline. Tony, the last thing I would like to mention is actually on page 13 of the presentation, which is the EBITDA adjustments. And this is a nice leave behind in case you're struggling to fall asleep at night. This is just a laundry list of things to be mindful for when counseling clients with respect to adjustments related to COVID-19, either with respect to preparing for sale or evaluating a new deal. We need to realize more than anything that the environment is very fluid, and this list may change, and adjustments may lose credibility depending on the recovery. But very obviously, you've got to be mindful, even in healthy businesses, of the potential, impact both on the P&L but also on the balance sheet. Tony, that concludes my comments, so I'll send it back to you.
Great, thanks very much, Ben. The next segment will be a Q&A session with April Miller-Boyce regarding deal-making challenges from a general counsel's perspective in a post-COVID-19 world. So please note that the views and opinions expressed by April are her own and are not intended to reflect those of Eaton or its management team. So April, I'll turn it over to you for the first question. While COVID-19 is certainly unique, your career has spanned several economic downturns and periods of uncertainty. In your experience, do companies typically take a more aggressive or more conservative wait-and-see approach as they formulate their M&A strategy in uncertain times, or are they likely to remain active and potentially take advantage of lower valuations? And what are some of the variables and factors that you would consider when evaluating those two approaches?
Sure, thanks, Tony. First of all, let me say I appreciated Ben's remarks, and I think you'll hear, it's just some consistency and themes in what we're seeing and what we're expecting, just based on both of our experience, in the industry and in the market. So I think, while there have been lots of other severe economic downturns, this is really like none other. I mean, this is a pandemic that really is impacting the entire globe and businesses in nearly every industry and every region in a way that we haven't really seen before. And I think it's really driving us to a new normal. And so, with that in mind, I think it really is going to depend on a company's balance sheets and their tolerance for risk. I think some companies will see opportunity on pricing resulting from the downturn. But again, I think it really is going to depend on the size of the deal. And, whether somebody, for example, would need to get competition approvals, to the point that Ben was making. If you need competition approvals, that's a really long lead time, and it's hard to do a deal with such a significant lead time. With this uncertainty, you kind of want to get in and get out quickly. So if you need competition approvals, there's concentration in your industry, or just the deal is big enough that you need to take that route. I think that's going to have a significant, people are going to weigh that significantly, just given the timing and the risk of getting a deal done when you think you want to get it done. I think smaller deals and, other deals with limited competition can get done more quickly, especially if, for example, you have a target that's vulnerable to a downturn in the industry. They might be more willing to, get a deal done quickly so that they can get some capital infusion and just maybe some relief with, combining their business with the business of the buyer. I think you might see technology investments by corporate. They might look much better now, as many of these smaller technology companies could see other deals kind of dry up, and other investments and cash might be hard to come by. They might be more willing to look at the pricing of an investment a little bit differently. I think we saw at the very beginning of the pandemic, when it was first starting, PE firms were really advising all of their portfolio companies to fully draw their lines, right? So that they could have as much cash on the balance sheet as possible. So a lot of those companies have plenty of cash. I'm not sure they're going to want to spend it, by doing kind of bolt-on acquisitions, but they might be looking at some, and if they see an opportunity and they have that cash, they may give it a second look. But I think, again, many of those private equity companies, just by nature, they're highly leveraged, and those interest expenses, really add up, particularly now if their revenue is really challenged. And so I don't know that we're going to see a lot of those deals, but they do have a lot of cash, and some of them will be looking for opportunistic deals that they can get done. And then, Ben mentioned this as well. I think PE firms themselves are going to be looking to get into, to get out of some of their late stage investments. So those deals, to the extent they can get the right pricing, which is a big if, those might look good too, if they're feeling compelled to sell at the end of their, time horizon for a particular fund. But, top quartile PE funds are pretty disciplined, when they're buying and selling. And so they're going to still be really careful. And I agree with Ben. I think, we're going to see a lot less kind of big company to big company deals or like mergers of equals, just because there's so much uncertainty, just both from a valuation perspective. Likely, both companies, if they're public, their stock is going to be down, and it's just going to be really difficult to potentially get to the right value or get the right value in exchange for the stock of the buyer. So I think those are some of the things we are going to anticipate.
Great, thank you. In addition to advising on the nuts and bolts of transactions, obviously, April, you're managing and helping to run a legal department. What role do you think a legal department can play in helping to manage the deal pipeline, either in terms of managing expectations of business clients, progressing deals internally, or otherwise?
Yeah, that's a good question. I would say number one, I think it's still really important to have a pipeline. I think that just having that discipline around, having a team in place and looking at deals so that you can stay, nimble and, flex that M&A muscle, if you will. Our role as counsel is really always understanding the goals of the business and, trying to make sure that we understand what an attractive target looks like and knowing who's out there, right? Who's in our industry, who's in our business. We always want to help the business weigh deals against one another, not just, of course, from a valuation and a strategic fit, but just the deal risk, the regulatory risk, the other business risk. And again, just making sure that our team is together and working really closely with the business development team. It's just great to drive and build those dynamics, so that if we are bidding against other people, we have the ability to be nimble and perhaps be much quicker to the draw, if you will. But, remaining disciplined, of course, that's always important. We want to do the right deal at the right time. We want to help our teams on diligence, whether it's, related to the management, the compliance, just other global business risks, knowing where to look and where to dig on a particular transaction. We want to be driving the transaction with our business development team and, helping them figure out what issues are really material and which ones are not. And so as you build those relationships, you start to build up that trust, and you get to know each other well, and you can really drive those decisions and help the team not get bogged down into kind of every little minutia or every little issue that comes out of diligence, and just getting them to focus on the big picture.
Sure, maybe just to follow up on that, how have you found interacting with your business development clients and other clients in the sort of remote environment? It's one thing to sort of be able to coordinate among sort of the legal department, but have you found it conducive, or any challenges in staying connected, both sort of substantively, but also personally with other aspects of the business with an organization as large as Eaton?
Sure. I think what we're seeing is similar to what I'm hearing from my colleagues in other places, other companies, but also to what we're reading in the business press, is that it's actually a lot easier than people anticipated. This having everyone working from home and working remotely, especially with a lot of the new technology like we're using today, and Zoom and WebEx and other technologies where people can see each other real time. You can see the video, you have screens up where you can kind of whiteboard on screen. You can have multiple people on at one time. I think people are finding it much more easy to collaborate, and this whole new way of working, I think, is going to change how we work and how we think about, office work going forward. And so it's something that we're talking about very regularly with our leadership team. And I know, kind of every company, if you were to look at what's going on with the Business Roundtable and the National Association of Manufacturers, you see these topics coming up very regularly. And you see it pretty much every day in the business press. What is the new normal going to look like? And I think, for technology companies, especially, we're seeing them say, hey, we think everybody can work from home, right? That was Twitter, I think, that said that. But even some of the financial services institutions, like, I think B of A and JP Morgan are looking at, what would that look like if a significant portion of our office workforce just stayed at home? So more to come, I think.
Great. And to turn back to Ben's presentation, let's assume for a minute that his economists are correct and that we are looking at a pretty steep recovery in Q3 and Q4. What are some of the key issues that you'd expect to be advising business clients on with respect to deals that may get kicked off during that phase of the pandemic?
Yeah, I think a lot of companies are looking at, pandemic insurance and business interruption insurance and what some of the exceptions are to business coverage and, trying to make some new and novel arguments around, why they should have coverage. So I think understanding whether there is coverage, in fact, and just understanding more generally the impact that the pandemic has had on, the particular business that you're looking at and what that cycle is for the impact, right? Is it a short cycle or a long cycle? And, do you think the worst is behind the company or is there really a lot more to come? I think we're going to be looking at the bounce back industry by industry and region by region and thinking about, where does that target fit in their industry and what's their, kind of right to win in their industry and their region, and just thinking about, again, how the pandemic is going to continue to impact them. Is the worst behind them? Do they have significant opportunities ahead of them? Or do you think, more is coming? I think looking really closely, Ben talked about the EBITDA adjustments, definitions. I think also looking at and thinking about the MAE definition and the operation of business in the ordinary course covenant. What does ordinary course even really mean right now, right? We just have a brand new ordinary and a brand new normal, and how do you think about that covenant and document that covenant in a transaction? I think, again, I think this pandemic is just different than we've ever seen, and I think you have to really take that into account when you're looking at thinking about papering a deal and not just kind of doing things the way you have all the time. I think some businesses are doing much better because of the pandemic. This has just brought on lots of opportunities for them. Companies like Zoom and some of the food delivery companies like, Grubhub and Uber Eats, certainly their revenues are way up. I don't know that they're actually making any money. And we've seen that as they've talked about, whether or not they're going to combine. But I think, again, thinking about your particular industry and what the pandemic has meant for that particular target that you're thinking about. And then I think also, thinking about how you're going to pay for the transaction. Are you going to be using your stock that's undervalued? Are you going to have cash on hand? Are you going to take on more leverage? I think, now probably more than ever, the capital allocation question is really important, and just thinking about what those options are and how it's going to be perceived by your investors, your board, et cetera. And then just thinking again about where the target's revenue has come from historically and whether that's going to change going forward as you're looking at what impact they've had or they might have as a result of some of these government shutdown orders, whether you are seeing a particular impact in one area of the world versus another. So for example, you've seen a significant number of days of shutdown in areas like India and Mexico. And so just thinking about the impact that's had on these businesses, are they going to be able to shift their operations going forward so that they're moving, manufacturing from one area to another? Again, thinking, is the worst behind them or is there just more to come? I think those are some of the major issues.
Yeah, and to follow up and dovetail a bit with comments from both you and Ben in terms of the importance of closing certainty and getting deals done. Certainly, you could anticipate a shift in deal psychology in a sense, in that it's been a seller's market for so long that sellers have always been so keen on seeking top dollar, and if they weren't happy with the price, there's probably someone else who was going to pay it. I'm wondering if that might all change a little bit, and there might be a shift in relative importance between deal economics and closing certainty. In other words, would you expect deal economics to take a back seat, relatively speaking, to a desire to get a deal done? Curious as to your thoughts on that.
Yeah, that's a good question. I would say yes and no. I think they're still both really important, of course, right? The economics of the deal are always important. You've got to justify that price whether it's to your board or your shareholders or just internally, there's got to be a business case for it. And just having that discipline around the economics of the deal is really important. But, certainly you don't want to do a deal at a great price that's never going to close, right? And so everybody is going to be thinking about that as they, again, look at their deal documents. So if you look at like what happened with L Brands, I think they thought they had a terrific transaction documented. They had really good documentation. They thought about the pandemic. It was included in their MAE definition. Yet Sycamore still, basically was able to get out of that transaction. And I think they probably just decided that they didn't want to, have a big fight with Sycamore, who was going to be a long-term investor after the transaction. So a little bit different than a buyout. But, balancing that certainty and the price, I think, is still going to be really important. And I think they probably just decided in this case, even though they had really good documentation and they thought they had, drafted in their certainty of risk, I think they just decided that probably the litigation would be too expensive, right? In this kind of environment, if you're going to be fighting for that long and your business is suffering, it's probably not worth it, even where you think you have baked in that risk. So I think there's still a balance. I think, again, this is just what makes it a really difficult time to get deals done.
Sure, that was a great preview for the next segment. Emily will spend some time talking about the L Brands case and a few others that implicated the MAE concept, as well as some other deals that get to deal certainty. Last question, sort of the favorite question for these types of panel discussions, sort of a catch-all, but how are you advising your team on the uncertainties, risks, time pressures, and constantly evolving legal regulatory landscape during the pandemic? In other words, what issues are keeping you up at night at the moment?
Sure. So, I think, like nearly every business and every general counsel I talk to, we're spending a significant amount of time, really evaluating and trying to mitigate the impact of the pandemic on our employees, just our business, around the globe and more generally, but also, looking at what's going on with our customers and our competitors and any long-term potential impacts on the industries that ultimately we're in. I think the regulatory landscape is keeping everyone really busy because it's constantly changing. Our business is very global, and we saw it in China first. We have a number of facilities in China, and so it's something that we spent a significant amount of time working on. In January, I think nobody anticipated that would impact the globe in the way it has. And so now we're spending a significant amount of time looking at the regulatory changes and the constant, new orders and new updates that are coming out from both countries and states and cities and counties. And, just thinking about that regulatory regime and that regulatory overlay in like China, which is, very much of a command and control kind of economy versus the United States or Mexico or the European Union, and just trying to stay on top of those regulatory differences and thinking about the impact on our business. I think government agencies are really distracted with the pandemic, and so it's hard to get other things done if you have other work with the government. So, we're a government contractor, and we're constantly just thinking about the, how much they're distracted and what does that mean potentially to our business. And I think just, deals are going to continue to be impacted by the pandemic for a long time, not just the business, but the business of getting the deals done as well.
Great. Well, thank you very much for all that insight. We really appreciate that from someone who's on the front lines, both in terms of managing a pandemic, but also trying to understand how deals are going to get done going forward. So next, we'll turn it over to Emily Farinacci, who's going to provide some insight on the much discussed and often maligned MAE, or Material Adverse Effect Clause, and some recent cases interpreting those provisions in the context of the pandemic. Emily?
All right, great. Thanks so much, Tony. So now I'm going to speak a little bit about the landscape, as you said, of those previously announced M&A transactions and the impact of COVID-19 on a buyer's right to walk away from a deal once it's signed, right? So the parties signed up a deal end of last year, early this year. Now they're sitting in the executory period and the world looks a little bit different today. So a buyer might be saying, maybe I'm having second thoughts. So as you can imagine, these days there's just a lot of discussion around whether a buyer has a legitimate right to walk away. But it really boils down to one issue, and that is, are the buyers asserting a termination right due to a legitimate change in business conditions in the target entity? Is the target entity materially different today than it was 2 months ago? Or are we really looking at a case of just buyer's remorse? The buyer is regretting signing the deal several months ago. So as we'll see, perhaps not surprisingly, and as April alluded, for many transactions where there is an argument over a buyer's right to walk away, where this has recently become an issue, the discussion has really focused on whether a material adverse effect, also known as MAE, has been tripped due to COVID-19. And just for some background before I move on, the buyer and seller will typically agree to insert among a list of pre-closing conditions that are required for the parties to close that a material adverse effect will not have occurred. So although if you just think about it, it might seem like an easy argument to assert these days, now that the world looks so different. But we have to keep in mind going forward that Delaware has only found one case historically in which a buyer rightfully asserted MAE as a termination right. So with that in mind, the MAE, practically speaking, the MAE condition may function more as a point of leverage for the buyer, or at the very least, a backdrop for the parties to come to a mutual decision to walk away. Okay, next slide. So what trends, if any, are we seeing with respect to COVID-19 and MAE walk rights? April, I know you noted that you're predicting kind of the larger merger of equal deals will probably be less common due to just the increased uncertainty. And that is, in fact, what we're seeing. So we actually conducted a search among public transactions that had been previously announced at the time of onset of COVID-19. And we found that on average, the number of deals that had been reportedly delayed, renegotiated, or terminated have in fact been on the rise. The reasons cited by buyers for termination or delay varied pretty widely. They asserted reasons like decline in value of the target's assets, inability to secure favorable terms for financing, lack of pre-closing access to target facilities. They just couldn't get to the target facilities in time to close, et cetera. So moving ahead, what's the basis for termination as it's tied to the purchase agreement then? So among the transactions that we looked at specifically, the buyer's rationale under the purchase agreement for delay or termination generally fell into one of 7 buckets. And again, this is general categories, and each of those are listed on this slide here. So Tony, if you go to the next slide, interestingly, out of 15 publicly announced deals that were pending closing that we looked at, only 3 buyers asserted the occurrence of an MAE in order to terminate. So only 20% of buyers went out at the outset saying, we want to terminate due to an MAE. So out of the rest of the subset, as you see on the slide, 1 buyer asserted the target company's failure to operate in the ordinary course consistent with past practice, which April, as you alluded, it raises an interesting question. What exactly is operating in the ordinary course in the midst of a pandemic? If we're looking at a retail company who closed its facility, in mid-March, do they have the argument that, well, yeah, we're operating in the ordinary course because we're operating in the midst of a pandemic, and this is what everybody else in the retail industry is doing? 2 buyers, looking at the list, asserted some form of breach of a specific interim operating covenant. There's a case that we looked at, Borg Warner and Delphi, where the target in the executory period drew on a credit facility without seeking permission from Borg Warner as the buyer. And Borg Warner objected to that, and the parties ended up delaying the closing, although they did decide to move forward. Delphi Technologies as a target company faced a purchase price reduction as a result. One case cited the doctrine of impossibility, Again, that's the simple argument that, look, we just can't fulfill our pre-closing conditions to, for example, inspect the target company's facilities to get to a closing. Another case cited lack of sufficient information or resources to close. 3 buyers asserted the failure to meet specific closing conditions prior to termination date for finance deals. A buyer might not be able to secure financing to close. And interestingly, 4 transactions we looked at terminated either due to mutual agreement of the parties and or unilateral termination of the buyer. So the parties might be looking at each other now saying, look, we're in unprecedented economic conditions. We don't really know the long-term effects on either of our businesses, so we're just going to agree to walk away and not worry about paying any termination fees as a result. So looking ahead a little bit, of these 15 transactions we looked at, 7 target companies ended up suing the buyer, challenging the validity of the buyer's termination argument and seeking an order to force a closing. As a result, several of these cases that we'll see in a second are now pending in front of the Delaware Court of Chancery. In one of those cases, L Brands that April alluded to recently settled and is no longer pending litigation. So just as a backdrop, before we start talking about these cases, it should be noted that Delaware judges do have a history of holding buyers' feet to the fire and to agree to move forward with these deals that they signed up to. And that actually might be a reason why we're only seeing a small number of buyers go at the outset and assert an MAE for purposes of termination. The one exception was a 2018 case that was in front of the Delaware Court of Chancery, and the Delaware Court ended up permitting a German corporation called Fresenius to end its takeover of a company called Acorn, which was a generic drug maker who suffered a dramatic decline in business. The facts in that case, if you look at it, are very egregious, and the Delaware Court of Chancery found that the decline in the target company's business due to a series of specific facts resulted in a dramatic long-term impact, negative impact on the target company's business for a durationally significant period. So those facts were pretty specific, but that's just to set the backdrop for these cases moving forward. All right, so let's look at 2 examples. The first on this slide is Bed Bath & Beyond versus 1-800-Flowers.com. On February 14th, 1-800-Flowers agreed to acquire Bed Bath & Beyond's personalization mall.com business for $252 million. The parties agreed to a closing date of March 30th, 2020. On April 1st, after 1-800-Flowers postponed the closing until April 30th, citing lack of sufficient resources to close the deal and integrate the business, Bed Bath & Beyond filed a complaint in the Court of Chancery alleging failure to close simply due to uncertainty and negative impacts of COVID-19. So in the complaint, Bed Bath & Beyond objected to the delay, arguing that, look, even a calamitous event such as COVID-19 doesn't permit the parties to avoid their own obligations. And I think it's important to note here that 1-800-Flowers did still want to proceed with the deal, but that the pandemic simply kept it from satisfying closing conditions, right, due to shutdown of the personalization mall.com facilities. 1-800-Flowers also did not invoke an MAE, although it did later admit that it needed additional time to assess whether an MAE had occurred. And we'll unpack that in a moment, but it's important to note that 1-800-Flowers didn't invoke that as the buyer as an argument at the outset, although it turns out that a lot of these transactions that did go to litigation, the MAE discussion ends up being a topic of discussion, even if the buyer didn't assert it at the outset, because the target would bring it out in the complaint anyway. All right, next slide. So let's look at L Brands versus Sycamore Partners. This was a case that was widely discussed in the news, so it may be familiar. On February 20th, private equity firm Sycamore Partners agreed to acquire a majority stake in L Brands, which is the parent company of Victoria's Secret, for $525 million. On April 22nd, Sycamore sent a letter to L Brands seeking to terminate the transaction agreement on the grounds that L Brands had supposedly materially breached the agreement. They cited instances like their failure to pay rent, they were furloughing employees, They shut down their stores to the point where Sycamore Partners said, look, the target is irreparably damaged and it wasn't operating in the ordinary course of business as a result of the COVID-19 pandemic. So interestingly, Sycamore actually went to Delaware, the Court of Chancery, and asked permission to walk away from the transaction. L Brands, in response to that, countersued the next day, asking for a specific performance to close or monetary damages. So L Brands argued that Sycamore Partners was simply having a case of buyer's remorse, and the parties were well aware of the existence of COVID-19 at the time. They entered into the deal on February 20th, and the parties mutually decided to shift the risk to Sycamore as the buyer as to any adverse impacts from the pandemic. So next slide, Tony. If we take a minute to look at the definition of material adverse effect, again, Sycamore didn't go out and assert MAE at the outset, but it ended up being discussed in the response complaint filed by L Brands. And as you'll see, the definition of MAE here was drafted to be extremely seller favorable. It expressly carves out the impacts resulting from pandemics, which sort of indicates that the parties were anticipating COVID-19 at the time they signed the deal. So if you just take a look at the definition, MAE is defined to exclude any state of facts resulting from the existence, occurrence, or continuation of pandemics, except to the extent that such a pandemic would have a material and disproportionate impact on the target company compared to similarly situated businesses in the industry of L Brands. So as April commented earlier, Sycamore Partners had a very steep hill to climb if it was arguing that material adverse effect had occurred, because it would have had to prove that L Brands in the retail space was disproportionately impacted compared to other similarly situated businesses in the industry, in the retail industry. So that would have been a hard argument to make. The parties did end up walking away, parting ways, probably, like April said, due to the fact that they didn't want to deal with protracted litigation. So to wrap up, we'll see if the Delaware landscape changes as a result of these cases that are coming out in light of COVID-19. Only time will tell, but I think it'll swing a lot on how MAE is defined. And with that, I'd like to hand the presentation over to my colleague, Will Henry.
Thanks, Emily. And to follow up on some of those points, so this part of the presentation sort of goes to make an analogy. What Emily was talking about is once the parties have been engaged, how do they break that off before the wedding? This part of the presentation really focuses on how do you prepare for that engagement and give yourself as many outs as possible, not that people do that. But with that in mind, to April's point, this is not something, getting out of deals is not something that parties want to incur the expense for. And then to Emily's point, so much of this is leverage that even if you negotiate the purchase agreement provisions really well, how far are you going to go as part of that before the parties either break it off or decide to go to litigation? And keep in mind that for the smaller deals, at least, not only do you have that expense concern, but you have two other sort of competing concerns as well. One is no one wants to be the acorn precedent and actually be the case that, or the deal that had to get settled in court and litigating either an MAE or impossibility doctrine or some other theory for walking away from the deal. And the other point is that you really don't want to, in the context of this these types of smaller deals, so sort of the sub $500 million scenario, getting to the point where you're actually negotiating the nitty gritty after the signing or sort of preparing for going to court. And the courts themselves are also closed, right? Or some of them are closed. And so as we anticipate things opening up over the next few months or longer than that, keep in mind that judges really, either are going to hear any arguments if you go to litigation remotely and may not have the greatest sympathy for a $20 million deal where a buyer wants to walk, even if that buyer is willing to pay the fees to get to that point. But all of that said, these provisions that we'll talk about for this part of the presentation go to preparing to have those discussions preliminarily before you get to court. So first is the interim covenants that we're talking about. So reasonable access to facilities. This is something that virtually no one looks at in any critical sense when you're negotiating the purchase agreement. It's one of the easiest provisions to negotiate, but it's highly relevant nowadays. So this is the provision where during the executory period, so after you've signed, before you close, the seller would give the buyers representatives and employees the ability to access the facilities. The problem is, right, if a city's under lockdown or a business is closed, it's not a scenario where it's like, the locks are on the door and you just have to get the, fix the locks and be able to access the facilities so that, people actually feel as a public health issue that they can't get in. And then likewise, any sort of third-party reports, so phase ones, benefits analysis, anything that requires stuff on site, you have to think about, if you're the buyer's perspective, are these things that you can do remotely, or are they impossible to do remotely, such as a phase one where you've literally got to dig up the soil and do testing? And if that's the case, how much do you care about that? So from the buyer's perspective, really look at this provision in a way of, are there things, and this is a theme, that we can front load to pre-signing? Can we somehow persuade a seller that would like to do phase ones prior to signing so we don't have to worry about that issue, even if that creates more lead time before we can actually, get to signing? Because if you get to that sort of midpoint where you've signed and you think you might be able to do phase ones, but one consultant says they don't want to do it because they don't want their employees to get sick or get exposed, and another consultant that's not quite as good or is more expensive is willing to do it, those are meta discussions that just aren't worth the time or the effort. Second is the fulfillment of third-party deliveries. So sort of two buckets really here: consents and notices being the first bucket. That's the idea that, before this, right, in the olden days, in January of 2020, there may have been less of a concern of getting a customer's attention or using that relationship to get the consent prior to closing. Now you just don't know, right? So in a morbid way, right, potentially that customer's employed on or laid off the employees that actually were the main contacts. That customer clearly could be distracted or could be in a worse situation, and so it becomes a challenge to actually get their attention, even more so than it would have been 5 months ago. And so that introduces closing uncertainty. So practically there, right, if you're the seller, as always, you want to make the required consents list as short as possible. But from the buyer's perspective, recognize that if you want the ability to walk, this is really your best chance to have a concrete right. Because if you say we need customer X's consent in order to close, and that consent can't be obtained because there's a the customer doesn't want to provide it, or they're not able to provide it, or whatever. That really is a black and white way to try and walk away from the deal. Now, conversely, if that consent is obtained, then you lose that ability. But just keep in mind the consents and notices are going to be incrementally more challenging to get in the near term. And then similarly, to April's point on the regulatory filings, all of these agencies are distracted and otherwise occupied with managing the effects of the pandemic. But if Ben's prediction comes true, where you got sort of a sharp recovery in the third and fourth quarter, you're going to encounter agencies that are first, occupied with pandemic issues. Second, we're already understaffed and may even be more understaffed. And third, are going to get overwhelmed with a deluge of claims. And so it's a long way of saying, I'm not an HSR person, but I don't expect that there's going to be any sort of expedited review for HSR. So just build in a cushion for those types of third-party regulatory filings or notices. Next slide. So I think one back, yeah. So closing conditions. So this relates to consents, notices, a couple things here. So one is employment agreements, option surrenders, anything that requires employees' attention. Again, as employees are laid off or furloughed at the target, that introduces risk. If everyone's working remotely or a portion of the employees are working remotely, those negotiations end up being harder. The employees themselves, understandably, are going to want more protection, so expect stronger negotiations from management counsel relative to any of those points. And then heightened sensitivity as well from the seller. So sellers always, right? So whether it was 5 years ago, 10 years ago, or 2 months ago, or now, always want that closing certainty. And so anything that imperils that, including employment agreements, they're going to push pretty hard on that. So move as many items to signing, control what you can. And I think early in the presentation, we talked about interim covenants or interim operations. No lawyers really like the concept of ordinary course. And so what I would recommend in general in this is, you've got affirmative covenants that will say you can't increase CapEx by more than this, or you can't incur debt, or you can't incur other expenditures relative to the business beyond a certain amount. Also consider negative limitations. So if you're the buyer, try to negotiate and say, well, we don't want the seller to reduce their spend by more than this. So if you sign a deal and then COVID ends up affecting an area disproportionately such that the seller needs to reduce their cost and their spend, as the buyer, you have a consent right, you have the ability to manage that, and that can give you significant leverage. So while you can use ordinary course in general, I really strongly recommend tying that to dollar values and something specific that you can point to, make it specific as possible. Outside dates tolling, so this is kind of the effect of everything that we've been talking about today, but when is the closing date going to occur? I agree with the predictions that if you can do a short executory period, people are going to be very nervous on really both buyer and seller side about long executory periods. If you can do a simultaneous sign and close, great. Unfortunately, if you're doing a deal that requires HSR review or any third-party issues or there's sensitive employee considerations, you'll have to have that segmented period, and you do have to go the ways of setting a later outside date, even if the parties are desirous of closing faster rather than waiting for a longer period of time. If you think that's going to close in 30 days, add 30 days to that. Set 60 days if you're the buyer. From the seller's perspective, of course, you'll always resist that, but I found in practice the discussions between buyers and sellers in the context of deals that haven't yet signed, it really depends on the personalities of the sellers and their counsel in terms of how sympathetic they are. I think from a human level, everyone understands that they've been affected, but the seller really doesn't, and I get it, right? From the seller's counsel perspective, isn't going to be overly sympathetic to the notion of tolling the closing date perpetually. And so if you're the buyer, really consider, the way it traditionally worked was that if you delayed closing, typically it was sort of the buyer's fault or the seller's fault, in which case one party would bear the risk of that. My take is generally that the pandemic's no one's fault. It just is, it is what it is, and we're all dealing with it. And so there really shouldn't be any breakup fees tied to the failure to close by the outside date. And so if you have a tolling provision, make it very specific relative to that. And then likewise, if you're the buyer, try to make it to the outside date termination right unilateral. We haven't seen much success with this. I don't know what the market will end up shaking on that, but if you can try to say, if we don't close by 60 days and we've tried everything else, then we need the ability to walk, and it'll give you a little more protection. Next slide, please. Unintended consequences, rep and warranty insurance. I still think it's going to be used pretty regularly. I do get a little worried about sort of the medium to long term for rep and warranty insurance, because I expect there to be many more claims against policies, since a lot of deals are going to see companies struggling over the next couple months and potentially years. For the deals that are signed, expect more pushback. Even if you didn't have a COVID exclusion in your policy from the rep and warranty insurer, they'll ask a lot of questions as part of the bring down call prior to closing relative to any effects of COVID. Some of that, auspiciously relates to sort of them trying to sandbag you and say, well, if you knew about some issue relative to COVID, that would be an exclusion. So just be careful there. For deals that aren't signed, just expect that you're going to get some type of exclusion under the policy for COVID. They've tried to go really broad initially, just saying anything relating to or rising out of COVID. That could pick up theoretically anything, right? So customer declines, financial underperformance. I don't know how insurers will actually react once you make a claim. I think we're too early for that. But I do think that you'll get higher scrutiny, and because there's going to be an increase in claims, I would think insurers are going to protect themselves by increasing premiums. I don't know what the magnitude of that would be, but I don't think you're going to look at sort of the 2 to 3% premiums. It might be 4 or 5% in the coming months and years, assuming revenue warranty policies continue to be used. Access to and use of records. And I guess this dovetails with the transition services concept too. If you can't get into the facility after the closing, so right, you couldn't choose not to close, but you still closed anyway. How do you deal with the shifts with a third of employees are actually going to be on location at time? And keep in mind that the incentive to automate and make electronic, move to a third-party administrative control of records, anything that applies to your business as the buyer, you'll want to probably move as quickly to the seller as you can. And next slide, please. This goes to the transition services piece. Keep, to the extent you need the seller's help in that in an asset deal, provide for a longer transition period. Consider those additional expenses that might be incurred as a result of having to get those synergies and other workarounds. Believe it or not, we've used drones in diligence. We thought about thinking of ways, Zoom meetings with management, right? There are ways to do that, both pre and post closing. So people have to get creative, and thankfully technology allows us to do that. And then last point, benefit plans. A lot of this is still too early, but just things to think about. I expect that you'll probably see COVID-19 specific benefits, especially if there's a drive for the vaccine. That could potentially increase cost-related premiums, or frankly, claims for short-term and long-term disability, sick leave, those types of things. Just thinking about that from a planning perspective, it might be worth talking with your brokers about. And then the likelihood of COBRA usage changing due to the inability of laid-off workers to find employment. So typically, this is just the thing where we think, once employees are laid off, they're entitled to COBRA for, I think, up to 18 months. But they'll find a new job, right? And I don't think anyone can make that claim with the same level of certainty at this point. And so you just have to think about the potential effects if you have to keep more employees on COBRA for a longer period of time, and what the expenses and administrative costs of that would be. So all of these are just things to think about as we go into the new world. I don't know if this ends up staying as the new normal or anything, but you know, so much of it is leverage, so it's just worthwhile thinking about as you negotiate deals. Tony?
Great, thanks, Will. With crackerjack timing, that brings us to the full hour. We'll now begin the Q&A session. We will address as many of the questions as we can in the time remaining. We'll plan on sticking on the line for 10 or 15 minutes if folks do have questions. If you're seeking CLE for today's program, the tracking code is TH0519. Again, that code is TH0519. If you have any additional questions after the webinar, feel free to contact your current Thompson Hine lawyer, who will direct you to a member of our COVID-19 task force. If you're not a current Thompson Hine client, please contact one of us, and we'd be happy to discuss with you any questions or options to address your needs. And with that, I will turn to the chat feature, the question feature, and I am not seeing any current questions, but again, we will stick on the line for a few minutes if folks do have questions. And again, just to repeat, the tracking code for CLE TH0519. If you are not currently receiving our updates or invitations, we invite you to go to the Thompson Hine website, register to receive our mailings under the Publications tab. Thank you all for your interest in attending today's webinar. Enjoy the rest of your day and stay safe.